Why I don't invest in international or emerging markets funds. And I'm not saying you shouldn't invest in them. I'm just saying I don't. All right. And so let me just share with you briefly. My first ever fund I owned was a Montgomery Emerging Markets Fund, which I bought in like 94, 93, something like that. And I bought it solely on the basis is it was the best performing fund of the previous year. I think I bought it in 94 because it was the best performing fund in 1993. There's another fund that actually was a little bit better. It was called the American Century Gift Trust Fund. Unfortunately, I called American Century and they said you can't invest in it. I can't remember what the whole point was. I didn't understand because I didn't know what I was doing. I just bought whatever was the best performing fund I bought. And that just happened to be the Montgomery Emerging Markets Fund, which of course no longer exists. There you go. Good job. I would show you Pablo pooping, but he's not pooping. Anyway, so I bought in 94, and I didn't know what I was doing. I think 95 rolled around. I needed the money, so I just sold it. And I don't know what it did, but all right. So here's why. Let's look at the Vanguard Emerging Markets Fund. Now, all the modern portfolio theory enthusiasts are going to be dismayed by me saying I don't have anything other than U.S. funds. All right, they're saying you should have investments in America. I mean, all over the place. That's MPT, modern portfolio theory. I don't think this is a mission. What's the efficient market hypothesis? Yeah, that's different. Efficient market hypothesis, EMH, modern portfolio theories. That's Markowitz. That's right. Harry Markowitz from the 50s. And they say basically diversification is the only free lunch. I don't buy that so much. I frankly don't care to challenge that in some regard like I do with paying a fee for active management. I don't care. I mean, diversification makes sense. I got no qualm with that. I like the Vanguard life strategy funds without question. But the problem I have with investing overseas is the way they can manipulate the currency exchange. All right, and I don't mean to sound like they're doing it nefariously. But again, if you look back at the history of the Vanguard Emerging Markets Fund, you've averaged since 1994 6%. That's it. And we've had some serious up years, also some serious down years. I mean, it's nuts. And we're talking 60% on the up, 50% on the down, over and over and over again. It's to get on average 6% going back 25 years. And part of the reason for that is, again, the currency, the exchange rates. Exchange rates do not have any effect on earnings per share or dividend yields, and so, but they do have a significant effect on the performance of investments that are held overseas. And when I invest not as speculation. I invest as investing, i.e., earnings growth year over year plus dividend yield. That's my investments, and that's what I look for. And I'm not saying you should do the same, but you should say if you're not investing like that, you're speculating. You're saying, I think X is going to outperform Y because I'm taking a bet on my intuition, my gut feeling, or just because I put on black. That's speculating. That's not investing. Investing is saying, I believe these stocks are going to grow earnings because whatever it is you fundamentally think. You know what I'm saying? I go to Walmart, it's busier than what it was before. Whatever it is, I don't care. That's investing. You're investing for the long haul, willing to take short-term declines in order for long-term growth of earnings and dividend yields. And cash flows can come back to you via dividend. Or the greater fool theory, i.e., I can sell this for a higher price in the future. That's investing. Speculating is different. And when it comes to international markets, the market, the currency exchange rate manipulation can dwarf any kind of investing growth, earnings growth, or dividend yield. And it just going back to Japan again. I mean, what was it? They're trading at 80 yen to $1 in the early 90s. You know, fast forward 10 years, they're trading at 240 yen to $1. I mean, even though the companies themselves are financially solvent, we're making money. Earnings growth was growing. I don't know what the dividend yields were paying. Or not the dividend yield, the actual dividend amount I don't know. But if the price of a stock was based on Japanese yen, and even if the earnings growth year over year continue to grow, we'll say 5% a year, and the currency drops from 80, the value of the currency drops from 80 to 1 to 241, that is dwarfing, destroying the value of the shares for you if it's based in Japanese yen, which it is because it's a Japanese company. So all your fundamental analysis, all your modern portfolio theory, all that stuff is thrown out the window simply because market a currency exchange rate manipulation. I mean, just, and then you look at the emerging markets mutual fund from Vanguard, 6.04% is your growth going back to 1994. It's not worth it. That's 25 years, 25 years, a quarter of a century. That's enough to say, you know something, at the end of the day, that's not enough up for the amount of risk you're going to take. The standard deviation, I didn't even look at what the standard deviation on that. What's up, dog? Oh, some people got these ghosts up here in the yard. Pablo's checking. He's like, see if I can't show you. Hold on a sec. Can you see him? Let's see what Pablo's doing. Look, see a ghost right there? Pablo's like, all right, come on, bub. He does not like those ghosts that these people's got in the yards for Halloween. That's funny. Have you ever seen the Easter Bunny? That's not the Easter Bunny. Oh, you've got to watch this on YouTube. Oh my God, it's the funniest thing ever. So they're showing the Easter Bunny. These people, I don't know where they're at, in Pennsylvania, someplace, I guess. And these two little kids are waiting on the Easter Bunny to come to the yard. And it looks like this guy did like the white trash version of an Easter Bunny costume. It is so flippin' funny. And so it comes up, he looks like he's Pet Cemetery Easter Bunny. He has like this big tooth hanging, you know, he's got his mouth wide open, this tooth hanging out. He's like limp, it literally looks like he's from a Pet Cemetery. He's like, and the kids are going, that's not the Easter Bunny! That's not the Easter... Oh my gosh. Every time I see that, it is the funniest thing. It's the funniest thing you've ever seen. Almost as funny as Cat in the Lampshade. You gotta watch this. Look on YouTube, type in, that's not the Easter Bunny, and tell me that's not one of the funniest things you've ever seen. It's actually quite frightening. You see that Easter Bunny, you look like, you remember that Stephen King movie, Pet Cemetery, from like the early 80s or something like that? Actually, I think they did an updated version of that. But oh my God, it is funny. And then you gotta watch Cat in the Lampshade too. Oh my I could laugh at that all day long. All right, so back to emerging markets. So over the course of 25 years, a quarter century of a history, you average 6.04, the Vanguard emerging markets. We'll just use that as our proxy. 6.04, that's nothing, man. That's not gonna get the job done. Now, from 2004 to 2007, the emerging markets fund tore it up. But we're talking, it did, you know, probably better than the S&P 500 towards the latter part of the 90s. The S&P 500 is averaged like high 20s, low 30% from 96 to 99. The Vanguard Emerging Markets Fund did the same. And then it proceeded to lose a half as the value at the end of 2008 or 2007 or something like that. I can't remember. But anyway, it just got hammered. So 25 years experience. You average 6.04% with huge volatility, standard deviations. I mean, you could have done as well in a freaking, basically a bond, like I always say about the Ginnie Mae fund. I don't know what the Ginnie Mae fund has averaged from 1994 till today. Probably not quite 6.04. Let's just say 5. You could average 5% in the Ginnie Mae with no volatility at all to speak of. We had 2 down years, one less than 1% in 99, one less than 4% in 2015, I believe. You could have averaged, well, again, I don't know what it was. We'll just say 5% for the last 25 years with hardly any standard deviation. In fact, the only standard deviation is essentially on the upside. So nothing. Now, people say, yeah, but Josh, you're not going to get the same in the Ginnie Mae going forward. Well, maybe. I don't know that to be true when it comes to Ginnie Mae versus emerging markets funds. I don't know to be true that the emerging market fund will outperform, especially when the rule of thumb for all emerging companies is to follow the old Japan model. Inflate your currency, i.e. reduce its value, sell goods to the rich companies, the rich countries, the US, and sit back and watch your exports explode and the money come on in. That's exactly what happens. So they're going to reduce the value of their currencies in order to boost exports. I mean, this is just mercantilism 101. reduce the value of your currency, boost exports, and watch the money come on in. Now, that works to some degree short term. I mean, anytime you inflate the currency, you get short-term benefits for sure, which is why Trump is wrong when he says we got to devalue and have lower interest rates. That does hurt. I mean, it will hurt in the long run. It usually gives you a benefit in the short term, and the short term is all a politician cares about. But in the long run, it hurts bad because people literally have lost value of their money. When they lose value of their money, it makes them less likely to invest in your country, because they can lose value once, they can lose it again and again and again. You'd be a fool to invest in Argentina, for instance. You'd be a fool. Argentina showed us it doesn't matter who the president is. What, Christina was her husband's name, Nelson. I can't remember the people before that. It's all the same. Doesn't matter. Devaluing your currency for an emerging market is what they think is the way to gain wealth. And devaluing your currency does what? It reduces your capital. It hurts investors, it hurts savers without question, and it hurts us here in the U.S. as well, because it's going to be devalued against the U.S. dollar. I don't trust any of that as far as I could kick it, so I said, you know something? I'm going down with the ship to the U.S. of A. And if the USA retains a strong dollar, which inherently we're going to, it's inevitable, then we control the capital structure of the U.S., the world economy essentially will be based, always pegged to the U.S. dollar. If it's pegged to the U.S. dollar, at least we know if we want to go and devalue our currency and hurt our own individual investors in order to compete when it comes to exports, which is silly, but you know, that's what the Keynesians would say. Well, at least I know we're going down with a ship. But I do not want to sit there and say I'm going to invest so I can get diversification is the only free lunch out there. I don't want to do that. Now, what the diversification proponents would say is, yeah, but Josh, from 2004 to 2007, when the U.S. markets were just kind of bleh, the emerging markets are kicking butt and taking names. And if you were rebalancing, you could have sold on a high and bought on a low or lower relative to the U.S. markets. Yeah, maybe that might have been the case. The same thing could be said if you would have done the same with the U.S. stocks in 1996, 97, 98, 99. You could, if you were rebalancing on a regular basis, you were selling at the high when it was high and buying emerging markets when it was low. Maybe. I don't care. At the end of the day, we've seen enough history of the foreign markets to recognize it's not worth the risk, in my opinion. It's just not worth the risk. Buy U.S., invest in the U.S., and be done with it. All right, we'll see you.